You're watching Quarter Se Quarter Tak, the show where we analyze and prepare you for the coming earnings season. With us are Sanjeev Bhasin of IIFL, Anish Damania of IDFC and Dhananjay Sinha of MK. Let's first get our own expert. We're going to discuss pharma and inevitably Ekta to tell us what to expect. Ekta.
Well, it's expected to be a Q-on-Q recovery for the India business, but overall, US is expected to still be pressured for pharmaceutical companies this quarter. Sun Pharma, Lupin, US markets still expected to be pressured because of lack of significant launches. Dr. Reddy's may see a sequential growth in terms of the US business due to a launch of Doxil generic. Aurobindo and Cadila should do well because Renvela generic for Aurobindo, the kidney drug, should contribute to US, and Lialda generic, the ulcerative colitis drug for Cadila, should contribute for their US business overall. For two companies, specifically when it comes to US FDA, that's going to dominate. For Biocon, commentary with regards to the Bangalore plant will be top of mind along with the biosimilar portfolio. And for Divi's, the recent US FDA remediation and reinspection will again be top of mind, and the impact on earnings will be watched out for.
All right, thanks so much for that, Ekta. Sanjeev, we've seen with pharma, that's really not about the sector, it's about individual companies. So let me ask you in company terms, the high flyers that might show that there's a bottom in place and the ones that will still struggle.
Yeah, so it's going to be a mixed bag. It means that results may not be up to what the market is making or maybe muted. But the price performance of those stocks has already bottomed out. And you want to take 5 large caps, you know, Dr. Reddy's, Sun, Lupin, Divi's Lab and Pfizer. These are 5 where we've been doing a SIP in the last 3 months, all on the back that the worst of generic pricing may be over, and FDA approvals now in the last 1.5 months have been the best ever since the last 18 months, which is telling you that the new launches and the new approvals which they get will have a lag effect of being launched in the next few quarters, and that will be when money comes on the table. So the timing may not be so easy, but we think most of the negative issues have been done with. And for Sun, it will be the launch of specialty chemicals. For Dr. Reddy, the launch of new drugs, which has been a very, very strong positive. And for Lupin, it will be the cut in R&D and further growth on their existing new launches. And we think that that could be a turning point. So for us, this has been a SIP which we've recommended in the last 3 months. And we continue to invest and recommend that do a SIP in pharma, because there will also be a conduit for the rupee, which will now become a tailwind if it tends to depreciate from here.
Sanjeev, that was a great summary of all the key stocks that we should watch out for and what we should watch out for. Buy the distress is the advice that Sanjeev is giving us. With that, let's go over to the winning sector, as it were, for the last, 6 quarters, NBFC. Abhishek, back with us. What should we expect, Abhishek?
Strong momentum is expected for gold financing business, but Manappuram's profitability may take an impact due to MFI's provisions. Consumer and two-wheeler financing has remained strong, so expect strong set of numbers coming in from Bajaj Finance and Shriram City Union Finance. On the housing sector, the impact from intense competition on the lower rates coupled with RERA may be seen, and therefore loan growth can take an impact. On the MFI and small banks, expect higher provisions to dent into earnings of Ujjivan and Equitas, but Bharat Financial can report net profit after reporting 2 quarters of net losses. Coming on to vehicle financing, post the GST implementation, CV sales trend have been really strong, upward of 25%. Therefore, strong earning momentum expected for Cholamandalam and Shriram Transport. Back to you.
All right, Abhishek, thanks so much for summing that up for us. Dhananjay, let me come to you. Do you think that earnings will come through to justify those NBFC valuations, and which are your top picks?
So our top picks are Bajaj for the quarter. From a quarter standpoint, it is Bajaj Finserv, Edelweiss are 2 leaders that we have identified from a quarterly result standpoint, and the laggards are LIC Housing and Shriram City Union Finance. Overall, the Chola Finance is so overall view that we have is that we need to really be focused on new niche consumer lenders, be away from housing finance companies. We believe that there will be intense margin pressure going forward. So from a valuation standpoint, we are somewhat circumspect for portion of the NBFC that will face more intense competition. I think from a quarter standpoint, I think it's going to be a mixed bag, wherein we are saying that if you look at those guys who are having large exposures in the SME space, those are the people who will sort of have a weaker quarter versus those that are actually directly lending, that are engaged in asset-backed lending, largely in the auto space. So I think that is the overall context that we are looking at. If you look at the MK universe, our universe of NBFCs, we are expecting an NII growth of 21%, largely led by Bajaj Finance and Edelweiss Finance. So these, as I said earlier, these are the two leaders that we are looking at. And the PAT growth is expected about 16%, but the drag over here will be LIC Housing and Magma Fincorp.
Okay. Well, take your point. The house is actually deeply divided on housing finance. There are some who believe margins will be under pressure, and there are others who believe that it will continue to be the safe sector. But when MK says that the rival Edelweiss is a great stock, that's really a large-hearted comment. Thank you, Dhananjay. Cement sector. Let's see what that will do in the second quarter. Nigel is here with us. Nigel?
Well, cement space is where, in fact, we've really been seeing the big hope trade play out. But the second half of the year is likely to look much better on a lower base. In the past quarter, though, what are we looking out for? For volumes, you're looking out for pricing. And the third factor you're looking out for is input costs have spiked up, which will hurt margins. In short, cost pressures are likely to offset higher volumes as well as any kind of pricing that we have seen. Demand as well was impacted because of heavy rainfall, scarcity of sand, and also we saw poor demand coming in from the housing segment. Though volumes will come in higher because ACC and Shree Cement, they expanded capacity. We had UltraTech and JP Cement coming together, so that as well will aid volumes on a year-on-year basis. And finally, Ambuja Cements will report volumes on a very, very low base. What plays spoilsport though is pet coke prices have spiked up, so that will hurt particularly Shree Cement.
Thanks for that, Nigel. Anish, all yours. Which ones would you back?
Yeah, so if you look at the cement pack, the only company which will report a growth in profits is going to be ACC. That's what our expectation is. Most of the companies are going to report declines, so sharp declines in net profit. I think you have to see this interesting phenomena. The first quarter was very strong in terms of both price growth, and it more than covered for the cost increases which we have. But ever since that first quarter, the second quarter has seen a sharp dip in realization, and cost pressures have remained elevated. So what you're going to see, not only would the volumes be lower than in the first quarter, in the second quarter, it's a seasonal trend, but also you will see sharp dips in EBITDA per ton. So, be it Shree Cement, be it UltraTech, be it any other company, you are going to see sharp, except for ACC, you're going to see sharp drop in EBITDA per ton and sharp declines in net profit. So cement, if you look at the performance of all the cement companies except for UltraTech, most of the cement companies have outperformed the market over the last 9 months, and I think we can see some of this outperformance taper away for a short period of time, given that these results could be a little weaker.
Okay, all right. So expecting moderate performance from the cement space. Let's move then to power and infrastructure. Anisha joins in. Anisha, that's like good news that we started getting in from power companies, better generation. Will that translate to numbers?
Well, yes, finally a bit of good news coming in for the power sector, as the generation has been strong, as we have been seeing in the core sector data as well. For the quarter, the growth was around 5% for generation. We have seen PLF improvement coming in for the likes of CSC, NTPC, etc. Even the merchant rates were higher this quarter, so maybe see some impacts on the likes of JSW Energy as well. In terms of capital goods, the ordering continues to be remaining weak this quarter as well. Remember, for Power Grid, it is sharply down. Even the execution was a bit slow on account of GSC as well as the erratic monsoons. For L&T, the case in point being where we are expecting the revenue growth to come at around 7 to 9%. Even if you look at the consumer durable space, the pre-festive demand has been a lot lower than expectations. So clearly, it seems like it is going to be a weak quarter for the industrials. Back to you.
Thanks a lot. That's quite a large number of companies, power, infrastructure. Sanjeev, any pick of the pack?
Yeah, so on declines, L&T, I think the net interest margins will be much lower, you know, you could say 7 or 8%. And they've indicated that execution has been a problem because of GST and so on. But the problem is that this will be the only, this is the best caveat which you have to growth picking up and capex, you know, expanding from the private side, which has been totally missing. So how long can you have government capex pick up? And we think L&T is the best conduit to play that. We also have an overweight on Siemens at this after this sharp correction, because we think power equipment and so on could be the other conduit. On the consumer durables, we think any decline in Voltas will be a very good buying opportunity, given that their Middle East businesses started to show a lot of traction, and that you know, will offset the weakness which may play out because of GST locally.
Okay. Point taken, Sanjeev. Well, L&T did tell, say in the media that working capital expenses will go up because of GST.
Okay, well, that's the entire cyclical space, the infrastructure and power space. Quick break on that note. But on the other side, we still have to take stock of what to expect from telecom, real estate, media, and the liquor industry this quarter. Stay with us.